No change would be a base case. That's the assumption. But here's the thing. You are concerned about hot wages. The Fed is concerned about having more concrete data. When you look at the ECB and you look at the Bloomberg now cast model, it suggests we are at 2% and we should be cutting.
Look, the problem is really the fact that Europe is really in a no-lending zone, right? We don't have much growth. But, what Alessandra said is true. I think there is still, 4.5% wage growth. And, what is called now sequential core inflation, which is without food, without volatile part, and without base effects, which is the main reason why inflation is coming down, it's 4.3% annualized rate, so still quite high. So I think it's going to be hard for the ECB to cut anytime soon. And I think markets are getting to the realization of that. So we still stick to a June cut or July cut even of 25 bips. But, the big issue is what happens if the Fed doesn't cut at all this year. That's the big issue. And this would be horrible for the ECB because we're a financial obligé. Whatever happens in the US has to set the tone to what happens in Europe. There's not like, the ECB being all of a sudden, in the lead and not a laggard anymore. We cannot do that. The financial flow risks are too high. So that is, for me, one of these tail scenarios that we need to watch very carefully because the US economy doesn't seem to get over the fence when it comes to calming the overheating.
That's probably a kind way to describe the ECB's relationship to the Fed. Others have put it more harshly. But, Ludo, when you look at Holtzman, Holtzman backs up what you said. He was speaking to Bloomberg last month and said, we're not going to cut before the Fed. So even ECB policymakers are saying that. But if I look at a country like Italy, for example, whose debt to GDP ratio is supposed to remain high, something like 140% until at least 2025, won't the ECB have an Italy problem, a periphery problem with these countries that still have high debt loads and are paying a lot for it?
Clearly the ECB is hoping to pass on the baton to fiscal. As you know, we are going, in a few weeks, we're going to agree on the fiscal rules, the new fiscal rules, which is this, customized trajectory to reduce, deficits. So by June, the Commission is going to get debt sustainability analysis to the countries, to the member states. And by September, they need to get their plan to get back on track, with a 3-year, 5-year, 7-year plan. The problem is by the summer, at least a dozen countries in Europe will be in the excessive deficit procedures. So your question on deficits is a big one for the rules. Italy just came out with more than 7% deficit because of the super bonus, this accounting issue, which it's still money that got out of the door, right? So there are fiscal credibility issues. And the ECB doesn't want to create fragmentation risk again. They don't want 2012 again. So the ECB is going to have, at one point, maybe to act in spite of their own will to act. That is a very possible scenario. And they may have to cut to lower a bit the pressure on some of these high debt servicing costs for some of these member states. And Italy is, of course, one of them. But you can mention my own dear country, France, and certainly Spain in the bunch. But this being said, I really do think that the main issue now is getting fiscal credibility back on track. But the ECB really has to make sure that they don't cut too early because markets could be spooked. My concern is that people think that the ECB cut too soon and didn't completely annihilate stagflation risk because of supply-side inflation. And that could be a major short for the euro bonds and for Europe and so forth. So maybe they first need to reassure the markets because of this, trial and error monetary policy that nobody understands what is going to come next, data dependency. And then they have to care for the policy mix and the Faustian wager between fiscal and monetary, which is not looking good right now, if you especially look at Italy.
You put a lot into that, Ludovic. I would just encourage you to reflect back to the... No, it's fine. Don't apologize. There's a lot to unpack. Go back and have a look at the Greek debt crisis, and you will understand that they will not show much benevolence to one nation in terms of...
It has changed.
Pardon?
It has changed, Marcus. It has changed massively. The original...
I know it has changed. I know it has changed, but it's still, and there are instruments at play to deal with fragmentation risk, which have proven to be very effective. There you go. There you go. I'm saying it for you. I want to go back. You can't throw in a tail risk at Danny and I like that. Big issue is if the Fed doesn't cut. So where do you come down on that? Because we've got a building narrative on this. Powell did not embolden the no-cut scenario or less than 3 cuts. So how much of a tail risk is 2 cuts, 1 cut, as was floated just the other day by Bostic?
Look, if the Fed were not to cut, to pivot by the mid of this year, I'm very concerned about the corporate segment. So corporate debt, high yield and investment grade, to be honest, because I really do think that we have a refinancing wall also in the US. Everybody talks about the refinancing wall in Europe. And of course, you guys have election this year. And so the reheating potential of a Trump 2 presidency is very high. So there is this idea of, going through the elections to avoid to have to cut and be stuck halfway into the loosening cycle because Trump reheats the American economy and then you have to hike again and you're in the mid-90s situation.
Yeah.
So there are two good reasons for this tail risk. I still think it's a very low likelihood scenario,
right.
but think about this. These are two major reasons why we need to be very careful about that particular positioning. And you've seen how markets have readjusted because the rally, the
right.
year-end rally and the expectation on the Fed to cut much before were very strong. And you see the inflation numbers and the wage numbers. It's no time to cut yet, but it's going to soon be the case if we don't want financial stability.
Hey, Ludo, can I leave it here back with the ECB and back with Europe? You talked about weak growth, but again, that sticky wage inflation means it's delayed. And so they can potentially handle the rates now. And we were talking to Callum Pickering earlier in the week, who said, look, it's weak growth, but not a weak immune system. They have buffers to shocks. But the question is whether they have a springboard to recovery. Ludo, when all this is said and done, and the ECB has started to cut or maybe on their way to cut, what are the chances that growth can come back to the Eurozone?
Look, our main springboard is real income effects. The idea that, we have a lot of savings. We have in France and Germany, we have record high savings rates still. And we have this, wage growth that is slightly higher than inflation by the end of the year. So that creates this consumer effect that has been missing in action over the past few quarters. And then a bit more exports, and that China, is disappointing, but that's it. And then, to be honest, I still think fiscal is going to be in the making, the mix. We have the guns versus butter versus batteries debate.
Yeah.
I don't see any consolidation happening from some of the member states. Germany is really isolated in that one. So for all these reasons, we may not be at the strong chutzpah that the US is experiencing, but I'm confident the second half of 24 is looking slightly better.